Welcome to Excess Returns, where we focus on what works over the long term in the markets. Join us as we talk about the strategies and tactics that can help you become a better long-term investor.
Justin Carbonell and Jack Forehand are principals at Mladina Capital Management. The opinions expressed in this podcast do not necessarily reflect the opinions of Mladina Capital. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Mladina Capital.
Hey guys, this is Justin. In this episode, we have the good fortune to sit down with Peter Mladina, Director of Portfolio Research for Northern Trust Wealth Management. Peter's research and work spans across a multitude of areas, including asset allocation, portfolio construction, manager selection factors, and best practices in portfolio and wealth management. Since we are discussing some of the more complex financial planning topics in this episode, we brought in our friend Matt Zeigler, who co-hosts the Education of a Financial Planner podcast with us to help with the questions. This is a robust discussion around important planning and investment topics. As always, thank you for listening. Please enjoy this discussion with Northern Trust's Peter Mladina. This episode is brought to you by Alpha Architect for Advisors. Whether you're an established firm or just starting out, you know the right systems can be the difference maker to achieving your growth goals. That's why Alpha Architect now offers a suite of turnkey model portfolios that can be customized to fit your practice. Built on Alpha Architect's decades of rigorous academic research, our model portfolios aim to systematize portfolio management so that you can spend less time tinkering with funds and more time finding your next great client. Systemize today to save time tomorrow. That's building with conviction. That's Alpha Architect for Advisors. To learn more about Alpha Architect's model portfolios and to schedule a consultation, visit advisors.alphaarchitect.com/models. That's advisors, ADVISORS.alphaarchitect.com/models. Alpha Architect for Advisors, built with conviction. Hi, Peter. Thank you very much for joining us today.
Hi, Justin. Thanks for having me.
In your career at Northern Trust, you put out lots of great research, things like asset allocation, manager selection, factors, goals-based planning, and we're going to try to talk about as much of that as possible in the next 50 to 60 minutes with you. But obviously, we had to kind of pick and choose where we wanted to focus the conversation. And it's going to be a really good one. I know that for sure. Jack and Matt are going to be doing most of the heavy lifting today. I'm just really opening it up here. And then I'm going to sit back and relax and learn along the way. So the thing I want to ask you out of the gate was, and I always find this very interesting when you have people that are actually out there at firms like Northern Trust doing what you do, but you also teach a finance class at UCLA. So I just want to maybe start there is kind of what got you into teaching. And then when you think about, your role at Northern Trust and what you're teaching, what would you say are the biggest maybe lesson that you've, I guess, learned in that experience?
Yeah, I mean, that's a great question. I mean, I think, when I sort of started in this industry, I mean, first and foremost, I'm a practitioner, right? And when I first started in this industry, what really struck me was sort of the disconnect between kind of, what you learn in school and what they talk about in academia and, what was really implemented in practice. And I always found that interesting. And at the same time, you learn some really interesting, great theories in academia that maybe sometimes are a little abstract and not so applicable to the real world. And then you notice in practice sort of very little of maybe what you learned in school is being applied. And so, to me, early on, I tried to kind of bridge that gap, right? Sort of bridge this gap of, what you learn in school and what's done in practice. And, philosophically, I've always kind of thought of that as sort of academically, trying to be sort of more academically rigorous, but pragmatically applied. And I think it's that bridging over the course of my career, kind of going back, reviewing key journal papers, et cetera, trying to understand problems I'm encountering in the real world and like, what does the real evidence tell you? That disconnect was just kind of too profound to me. And I kind of built a career, I think, bridging the two in a lot of ways. Because I think at the end of the day, if you're able, as investors, we're all sort of forward-looking. But if we can make our forward-looking views predicated on sort of, a good theory that's supported by empirical evidence, we're more likely to make predictions that are kind of valid, right? And so, as I kind of went through my career, I continued to try to make that bridge. And out of that, I think came me writing my own papers, giving industry presentations, being asked to be a guest lecturer at universities. And eventually then I think evolved into, basically being a professor at UCLA also and teaching a master's level course in financial economics. So I don't know if that really answers your question, but I think at the end of the day, I think it was just sort of this career of trying to bridge kind of theory and practice to make practice that much better. The other thing I'll say, which is interesting, I think, is in practice, we encounter all sorts of real world problems that naturally lend itself to true research, right? In academia, they have the opposite problem where they're always trying to come up with research, but they don't encounter as many real world problems. And that kind of put me in a position, I think, to kind of tackle real issues and research them to kind of provide better answers, I think, than maybe many of us practitioners have had to date. So
I think what's so cool of that is, so first off, you should know probably for 10 plus years now, I've been reading your work and following the stuff you're putting out there, because this podcast, or part of this podcast series, is the education of a financial planner. And when I found your work at first, the thing that jumped out immediately was this idea that, hey, here's this guy who's actually talking about real world problems, not just some strange view of it, but you're actually taking stuff, breaking it down, and then applying the academic rigor to it. And that was a big reason your name kept coming up in these conversations, that we wanted you on this podcast. So if it's okay with you, let's dive into some of that stuff that's real world problems applied to the academic side, how we think about it, and why professionals think about them this way. Does that work for you?
yeah, that'd be great. That sounds like an interesting conversation.
Awesome. Stoked to have this with you. So let's start with goals-based planning, because I think this is where your work really, really stands out. So when you talk about goals-based planning, why it matters, how do you explain it just to like regular clients or even like your mom?
Yeah. So, I mean, at the highest level, if you step back and think about it, it's so intuitive, right? Like, assets should serve a purpose, right? And so much of the investment industry is sort of divorced from this idea that these assets ultimately serve a purpose. And what is that purpose? It's to fund something, especially in private wealth, right? It's to fund some sort of a set of goals or a liability stream. We all have consumption goals or consumption liabilities, right? What's our lifetime spending needs, whether we're retired or not? We have other goals. Maybe we want to, provide for the next generation and provide some gifting objectives. Part of our goals beyond sort of just lifetime consumption, maybe philanthropic goals. And so at the end of the day, if you step back and think about it, the assets in our portfolio, and not just our portfolio, our sort of future income flows that may ultimately become part of our portfolio, ultimately they have a purpose attached to them. And really the optimal investment strategy, it always struck me as unusual that how is it the optimal investment strategy doesn't even consider what the purpose of the assets are, right? So you think of traditional asset allocation, traditional mean variance, modern portfolio theory, the optimal solution doesn't even consider what those assets are there to do. And so, a goals-based approach then incorporates the goals, the future, let's call them liabilities, of a particular client, and incorporates those into the optimal investment solution, right? So therefore your asset allocation, the optimal solution, is more complex than traditional modern portfolio theory in the sense that, it's not asset only, as they like to say in the CFA Institute. It's not asset only, right? But it's liability or goal relative, right? So the optimal solution doesn't just think about assets, but it incorporates what the whole purpose of what those assets are trying to do.
So inside of that, you're talking about, which is great because every asset's supposed to have some type of purpose, right? So we also know, and you kind of hinted at this with the consumption versus gifts piece. How do you think about, or how would you frame the prioritization of different, or in some cases, competing purposes?
Yeah. So, right. So this gets to maybe, first of all, like a difference between a liability stream that a pension plan might have and a goal profile that a private client might have. I mean, the interesting thing there is that, a pension plan will, essentially, based on longevity risk, future participation rates, et cetera, they'll just sort of accept as is a liability stream, and it's a legal liability. This stream of future cash flows is largely, kind of homogeneous to the pension plan, the sponsor. That differs from a goal profile for a private investor where it's far more heterogeneous, and it's not a legal liability necessarily like it is for a pension plan, right? It's heterogeneous, the goals are discretionary, they can change, and there can be different risk preferences around funding those goals, so different priority levels. So, I mentioned kind of lifetime consumption, like that's usually the biggest, largest goal for most private investors. And generally it tends to be the highest priority, but not always, right? You have to step back and realize that every sort of sub goal or mental account, it's another way that it's kind of been talked about for a private investor, can have different risk preferences associated with them, different prioritizations. A bequest far off in the future may be lower priority than, consumption today, or maybe the purchase of a vacation home in a year or two, right? So understanding, that goals are heterogeneous, that they're largely discretionary, that you can adapt and change them as you move through the course of your life, like unlike a pension plan's liability profile. That said, some goals may actually be legal liabilities, taxes due, mortgages that need to be paid off, things like that. But the reality is, goals are actually more complex. The interesting thing is, since clients have, or investors have control over, clients have control over not just assets, but they have control over goals too. And that creates a much richer set of, kind of tools in the toolbox that you can utilize in kind of developing an investment strategy over the course of a lifetime.
So let's drill into that, because this is maybe a little more CFA level type stuff, but you have the purposes, you have the range of them, and then the assets that meet them. And it's not a legal liability, because we're talking private client for a second, not pension here. But I know there's some things that model along the same lines. Now talk a little bit about how you build a portfolio when you have different things, because, and maybe you want to touch on the intertemporal capital asset pricing model or some stuff like this that you've written about, but you can almost have different portfolios inside of a bigger portfolio to meet these various purposes. How do you think about that?
Yeah, exactly. That's exactly right. So we're going so step by step, right through a discovery process, it's important to understand, there's an aggregate goal profile, but that aggregate goal profile is really just a function of the roll-up of all the individual goals a client or an investor may have, right? And, as you walk through that process of identifying and discovering an investor's set of individual goals, discrete set of goals, you're going to identify their risk preference associated and the priority level associated with each of those goals. And you're going to effectively walk through the process of how much of each of these goals do you want to hedge out effectively, right? And so we're going to create an asset liability sort of hedging approach whereby, hey, if it's a super high priority goal, it's forthcoming in time, the investor may decide to hedge out the risk completely associated with that goal. On the other end of the spectrum, a goal may be far out in time and sort of lower priority or more aspirational, and they may decide to hedge out a lower portion of that goal, and maybe decide to hedge out none of that goal and align it with sort of higher, kind of return-seeking risky assets. Either way, we're going to align assets in a way that are available to fund the goal, but we can basically design what we call effectively goal hedges to hedge anywhere between 100% of a discrete goal and 0% of a discrete goal. A goal that is basically unhedged or unsecured would still be funded on average with a risky return-seeking asset, but there's no guarantee around funding that goal, right? There's far more risk around it. In contrast, goals that are either in part or in full, hedged completely, we're going to construct portfolios that are duration matched with those goals, high grade bonds with appropriate amount of inflation protection to really give you the most amount of security and, basically funding those goals or a portion of the goals that are, aligned with, again, the proper risk preference, the proper set of, the proper priority level. Now, just to geek out a little, why is this important? And you mentioned an CAPM, right? This concept of optimal goal funding with, kind of these two sub portfolios, a goal hedging portfolio, duration, duration aligned, high grade bonds, and then sort of a return seeking risky asset portfolio. When you create portfolios that way, the interesting thing that comes out of that is not only like really precise risk specification and optimal goal funding per goal. At the same time, the aggregate lifetime liability or lifetime goal profile is a roll-up of the individual sub-portfolios, and the total portfolio is efficient, and the sub-portfolios are also efficient under this ICAPM model. If you try to use a curved efficient frontier using traditional MPT, you end up with a situation where the total portfolio may not be optimal, even if the sub-portfolios are, which is kind of a strange technical issue. So it's really interesting, and it's intuitive to investors also to think about, hey, I have these two sub-portfolios in this ICAPM, this intertemporal capital asset pricing model, and I can hedge, some or all of each of my goals, and then fund the rest, the unhedged portion, with these return-seeking risky assets. And then each sub-portfolio is optimal, and it rolls up to an aggregated optimal total portfolio.
I think that's so interesting. And especially that idea of the time and duration on one side, and then the risk mapping on the other side of how much you want to hedge for that goal. And that's something in some of your papers that was the immediate connection for me. I have to ask too, Ashvin Chabra, in his work, you used the word aspirational. Was that a direct reference to that, or just in terms of?
Yeah, I mean, I think, I'll have to think back to where that term was first used, and it probably was Chabra. So, give kudos out. There's a long literature of goals-based investing, and it's not all, there are different threads of it, right? Like, I think what we've developed at Northern, for example, really comes more out of, again, it's got this ICAPM based flavor to it, which is, I think, more academically rigorous than maybe other strands of goals-based investing. And at the same time, there's a connectivity to kind of, sort of the hedging return-seeking portfolios approach that is more commonly used in amongst pension plans, but applied for private clients with discrete goals, right? And the uniqueness there, which includes all sorts of additional complexity, like discount rates that include tax and, inflation adjustments and all that kind of stuff. But I think out of the more traditional strand of goals-based investing, there are concepts like, probability of goal funding and things like that, we've incorporated into our own tool set, but I think our additional views of risk to contemplate. There are problems there, like, again, not to get too technical, some other approaches to goals-based are very much focused on kind of just probability of outcomes, and the problem there is that you can have something with a high probability of success, but in the left tail, you have very severe magnitudes of failure, right? And so, like, another simple example is, let's say you use cash to fund a short-term goal. You have a cash discount rate. Your expected outcome of success may only be 50%. There's such tiny dispersion around that outcome that you really don't care if there's a shortfall because it's so tiny, right? So traditional approaches, or some of the early, not traditional, but the early approaches to goals-based investing, kind of fail on that route, on those concepts. And again, in our tool sets, we've built all this in. So there's all sorts of dimensions of additional risk you can contemplate on the just sort of, goal hedging versus return-seeking risky assets.
What about just stepping away from just the asset and the liability side? You've had some really interesting things to say about human capital and thinking about both human capital sort of when you're in the savings mode and how that shifts as life goes on. So what would you add to this goals-based conversation around the human capital component?
Yeah. So, right. I mean, human capital is very interesting because, at the end of the day, we're trying to fund, a goal profile of a client, right? Which exists over the course of an entire lifetime. And those goals are multifaceted. And so it's not just the investment portfolio that's there to fund it. It's sort of the investment portfolio plus all, let's call them kind of non-traded assets. And human capital is, for most people, kind of the largest, biggest non-traded asset they have. And it's an asset that is available to fund current and future goals. And so you have to incorporate human capital into the asset allocation solution, the investment solution. If you are still working and earning and you have huge human capital today, those are inflows today that can fund contemporaneous goals. And if there's a residual of human capital inflow above and beyond what is required today, right? Let's call that net human capital. That net human capital can be saved, and that can be, entered into the portfolio and fund future goals. And so, any sophisticated goals-based approach needs to take into account human capital, Because again, it's net human capital that are assets available to fund future goals, and current human capital can fund current goals. Now, how do you consider human capital? This is where I think the risk profile of human capital hasn't been fully resolved. And what's interesting is that depending upon how you define the risk of human capital, that can have that results in different asset allocation solutions. So is human capital really low risk, like an investment grade bond? I don't know. Like for some people it is, for others it may be more like a high yield bond or more like equity risk. Furthermore, as you think about inflows into a portfolio, it's not so much your aggregate human capital, it's your net human capital. And the variability of net human capital and the ability of an individual to save is actually highly volatile. So, the behavior of that net cash flow component behaves far less like, I think, an investment grade bond and more like a high yield bond or even equity. And as soon as it starts doing that, that actually has implications, not just for goals-based approaches, but how people think about, kind of a loose or retail analog of goals-based investing is sort of retirement solutions, right? I have always said that the most optimal retirement solutions are really goals-based investing, but, maybe there isn't the scale to do this across, kind of the average or the mass affluent client or investor. But an ability to build more rigorous goals-based approaches into kind of creating customized goal retirement solutions, I hope is the future. I think the industry is far from it, but there's a huge opportunity there if we can use technology to scale it up properly. But that's where human capital really matters a lot. And it has implications for thinking about glide paths, for example, right? Like there's all sorts of problems along prescribed glide paths. First of all, they're not customized to unique goals or assets or risk profiles for the most part. But that definition of what human capital is, how risky it is, actually would have an effect on a future glide path. I wrote a paper on that with a partner of mine, Charlie Grant, once upon a time. But it's the big puzzle that's largely ignored by most investment practitioners that actually has a significant influence on funding goals and actually the dynamic asset allocation for forward-looking investors. So.
Well, this is tabled for a future conversation, but that specific idea of how you drill into the behavioral finance and the other stuff on both sides of human capital and invested capital is the coolest thing in the world to me. So
yeah, it's to your point, it's complex. And I mean, there's still more work to be done on it, but I mean, only recently you take providers of retirement glide paths starting to think about like one of the only economically, so like one of the main justifications for a dynamic asset allocation over a constant asset allocation is just human capital. And a lot of people don't even know that, right? Right. There are technical reasons, like you can replicate all sorts of glide paths with some sort of a constant asset allocation. Most investors don't know that. Once you realize I can replicate, a Vanguard or a Fidelity or whoever's, retirement glide path with some constant asset allocation, you understand why you can do that. Then all of a sudden you ask yourself, why would you have a glide path? And the best answer is because of human capital, and that becomes a whole more complex discussion. So.
Well, that's awesome. So I don't want to steal all the spotlight here, and I want to hear the answers to some of these factor questions. So, Jack, I know you're sitting patiently biding your time. We just hit glide paths and human capital. What do you got for Pete today?
Yeah, well, I apologize for the hard pivot here because we're going to go from purpose and goals to me being the factor nerd here and digging into factors.
It's all related.
It's all related.
This is kind of my sweet spot, though. You can tell Matt that other spot is Matt's sweet spot, and this is kind of mine. And I want to ask you, you wrote a great paper, Stock Market Risk Factors and Manager Performance. And I want to ask you about some of the stuff in there, but first I want to just ask you about factors in general, because it seems like we've gone from, we've got the major factors, value and momentum and quality. Now it seems like everybody's coming up with factors every single day. And I'm just wondering if you could talk about what you think the criteria we should use to judge factors, like what makes a good factor?
So I think this is a great question, and I'm happy you started with it as we transition over to factors. Because you're absolutely right. I think we need the right definitions, and you kind of read through the long history of factors, which I guess, maybe other than the CAPM, the seminal papers from there came from Fama French in the early 1990s, right? And you kind of go through the literature, and then maybe you actually got to go to Merton and the ICAPM to kind of originally kind of start to think about a definition of a factor. Stepping back, I think taking all that research together, I've always said, and I kind of define these in my papers that kind of evaluate and investigate factors. There ought to be there are three criteria to a common risk factor. So, let's call these also compensated sources of risk or risk premia. But stepping back and understanding what a common risk factor ought to be, criteria number one is ought to have a return premium associated with it, right? And so there are different ways to think about that. Like, in the factor literature, historically, the return premium would just sort of be however it is defined, this return premium. In the case of the market factor, it's simply, the market return of equities minus the return of treasury bills. In the case of the value factor, it's simply the return of value or low price stocks minus the return of growth or high price stocks, right? That return premium ought to be statistically significant historically, because at least that will give you, some high confidence that going forward, there's an associated return premium. So that's criterion number one. And what does that mean? It means it is a compensated source of risk, right? I mean, that's the key insight there. There are all sorts of sources of risk that are uncompensated. And why would we care about that? We wouldn't. We would diversify that away, right? Like, the risk of individual concentrated stock, the risk of sectors, the risk of, one region, Europe over the US or whatever. If those don't come with risk premia, we would simply diversify them away and hold them in this broad market portfolio. So that's number one. With a return premium, it's a compensated source of risk. So number two, related to that, is it should explain it should explain the risk or the systematic risk, the co-movement, the up and down of assets and portfolios of assets, right? So, that definition of a common risk factor, criterion number two, is basically it explains the systematic risk of assets and portfolios of assets. So the common risk, the variance, the up and down movement of the portfolio. So again, putting the two together, we have a compensated source of risk, right? We have a return premium, so it's compensated. And then it's also sort of explaining risk, right? It's explaining variance and the movement up and down in a systematic way, right? These assets co-move systematically. Number three, the third criterion would be, and this gets to kind of this proliferation of factors, they shouldn't be redundant sources of return and risk, right? We don't want sort of like, to say like a PE ratio or a price to book ratio or a dividend yield ratio. Those are all sort of just different phenomenons or different manifestations of the same underlying phenomenon of value, for example, right? And so we just want to make sure that, these things aren't redundant, because again, as we're going to use them in factor models, at the end of the day, another way to think about this is we want them to be sort of, uncorrelated with each other. So they're not redundant, or ideally they'd be what's called orthogonal, but that's really a high bar to chin. Let's at least say they're all uncorrelated with each other. So they're not redundant sources of return and risk. Now, not to give you a long-winded answer, I just think it's a really good question. The fourth one, and this gets to some of my research in my paper, ideally, in an ideal world, I'd add a fourth criterion, and that would be that common risk factors should have a sound theoretical foundation based in risk, right? And so, is it just a product of data mining of the historical record, right? Where there isn't a good theory around a risk factor existing, or is there a good theory for it? So stepping back, the market factor for equities in a capitalist system, we would expect people who invest in equities to be compensated for bearing the risk in financing firms, right? In contrast, the momentum factor, although it has a highly statistically significant return premium, the theory around why that should be a foundation of risk is sort of less clear, right? So a lot of other factors, I think that that theoretical foundation of risk is a little less clear. But why is that important? Because I think if you do have a foundation, good theoretical foundation for risk compensation, then again, what I said in my opening comment was then you have higher confidence that it'll work going forward, right? I think to make, again, stepping back to like the scientific method, you want a good, well-reasoned theory supported by empirical evidence. The two together are more likely to make accurate forward-looking predictions. Empirical evidence without a sound theory, less likely to make accurate predictions going forward.
Before we dig into the paper a little more, I would ask you about one thing you said, because one thing I think a lot of investors don't recognize is that we're using a lot of these factors in a long-only framework. All the testing is basically done in a long-short framework. And so I'm wondering, like, what do you think the practical implications are? Like someone using these factor funds in the real world, how should they think about that and how it sort of impacts the way these strategies are run?
Yeah, I mean, I think, so that's an interesting question. I mean, you can go down some really technical issues there. But I mean, let's look at like size and value where, where there's a lot of implementation in long-only portfolios, right? And you can implement sort of analogous exposure in long-only portfolios, by sort of, in the case of size, right? The analog to a short exposure to size would be an underweight to growth, right? Without necessarily going to small stocks, right? And so there are ways to do it in size and value. You see in long-only portfolios, you're able to achieve pretty large size and value betas in long-only portfolios, even without going short size or going short value. Now you go over to some other factors like momentum, or even, some of the quality factors. I'll use sort of the Fama French definitions of quality, which would be, let's call it profitability. They're two newer factors, profitability and investment. To me, if you step back and think about it, highly profitable firms that need to invest less are analogous to quality firms. In other words, to maintain your profit margins, your profitability, it requires less CapEx going forward. So collectively, I sometimes think of those two Fama French factors as sort of proxies for quality. But I found that those are also harder to achieve, especially profitability and larger betas and long-only constructs, which suggests maybe you need to go long-short to capture them a little bit more effectively. But then when we evaluate strategies that try to do it, again, in practice, it's a lot harder than kind of the clean factor constructions that come out of academia. So, I mean, I think it depends on the factor. Some are easier to implement long only than others. And I do think you bring up an important issue. But again, there is an analog on the short side. You don't necessarily have to go short. You can sort of underweight what that short side suggests to kind of capture the exposure in a long only portfolio. And firms have done it. There are firms that have been doing that, particularly with size and value for a long time, and been pretty successful at least capturing the betas. Whether or not there's a return premium associated with it's a different question. I think that kind of gets to my paper.
In a paper, you talked about the three-factor model, and I want to take a step back because I remember back in college a long time ago, we looked at CAPM, and there was only one risk factor, and you sort of used that to determine whether there was alpha or not. And this sort of changes things a lot using a three-factor model in terms of what alpha is and how hard it is to generate and a lot of things. So I'm wondering if you could just talk about that, how what alpha is kind of changes when you shift from the single-factor model to a three-factor model.
So I think another good question kind of goes to your first question. So in a CAPM, we just have one factor, the market factor, right? And so CAPM, simple and straightforward interpretation of alpha, which is alpha. If alpha is positive and statistically significant, using CAPM to regress again, we're going to use the CAPM model to regress the returns of a particular fund, for example, against that market factor. And then we're going to interpret the betas in the alpha. So in interpreting the alpha, all it's telling us, well, first of all, you have to ask yourself, is that alpha random, which it almost always is, or is it statistically significant? Assuming it's statistically significant, then there's evidence of a return premium there, right? That's what the alpha is. It's a source of return that's unexplained by the CAPM's market beta or the fund's exposure to market risk, right? And so stepping back, how to interpret that alpha? It's really one of two things. Conventionally, folks have interpreted it to be excess return, risk-adjusted excess return for manager skill, right? But it also could simply be that there's missing factors in the factor model. Maybe there are other sources of systematic return and risk that are not included in the CAPM that are explaining that alpha. So we know there are other risk factors out there. We've talked about size and value, for example. Maybe it's momentum, maybe it's a quality factor. But let's say this fund intentionally exposed itself to a trading strategy that significantly overweighted small value stocks. That historically over a long period of time was associated with a return premium And it turns out in that CAPM model that showed up as a statistically significant alpha. Maybe we thought at first blush it was manager skill, but upon deeper due diligence, we added to that factor, that CAPM factor model, two more systematic sources of return and risk, size and value. We reran that regression. All of a sudden, that alpha under the CAPM that was statistically significant became close to zero or indistinguishable from zero, because it then became statistically insignificant. So now we know it wasn't actually manager skill that drove those returns, but rather exposure to a known systematic risk premium, small and value stocks.
And this sort of gets at the conclusions of your paper, because in this framework, it would seem that it would be much more difficult for managers to generate alpha. And, you looked at managers with this framework, and you kind of said, like, in aggregate, what kind of alpha is being generated. And I was wondering if you could talk about that a little bit.
Yeah. And actually there was a prior paper that actually, I think, tees up the stock paper far more intuitively. It was called Bond Market Risk Factors in Manager Performance, where we're trying to understand, again, we're practitioners, right? What we really want to understand is, there's this proliferation of factors, and, a lot of asset managers are trying to use them mostly to harvest premia, create products and harvest premia, to kind of, generate higher returns than just sort of, an index fund, for example. And in that bond market, and so what we're most interested in is, like, what genuine common risk factors are actually at play in live traded portfolios where investors are actually bearing them and receiving compensation for bearing them, right? That's a very different approach than just sort of using historical data to run back tests, which could simply be the result of data mining, right? We want to see if these things are really genuine common risk factors in traded stock and bond portfolios. So getting back to fixed income, where I actually think factors are far more intuitive and far cleaner and represent my four criteria, right? Including that fourth criterion for a sort of theoretical foundation of compensated risk. As we have three factors in fixed income: term, which is interest rate risk; default, credit risk; and prepayment risk. And in those tests, as we added each factor, like when we started with just term risk, we had all these funds in this long history of decades of fixed income fund returns that generated alpha, right? Like a third of them did, statistically significant alpha. When we added a default factor, we significantly reduced the prevalence of alpha. And then when we added a prepayment risk factor, we almost totally eliminated all statistically significant alphas. And so that's interesting, right? For fixed income, we have three sources of return, systematic sources of return and risk that meet all four of our criteria for common risk factors. So when we did the same thing for equity, a little bit, it surprised us, right? I mean, we've been advocates of investing in common risk factors, and we sort of thought we would get similar results, like starting from the CAPM. As we added things like size and value, we would think we would significantly reduce alphas, because those sources of systematic return, these factors, should be eliminating alphas just like they did with fixed income. We didn't see that happen at all, right? As we added size and value, we didn't really see a material reduction in alphas that we thought we would have when we evaluated, again, live traded portfolios. And then it wasn't just size and value factors that we added. We added sort of that zoo of factors that are commonly considered, momentum, quality factors, low volatility, or, betting against beta factors, even liquidity factors from the literature. We tested all that stuff, and it really didn't improve upon the factor models and sort of explaining away genuine return premia and traded portfolios. Surprised us. Now, I think one big finding we did find was that it could very well be that all these factor models all along have sort of misspecified the risk-free asset as T-bills. And really all along, I mean, interestingly enough, like a simple miss in some ways, right? Maybe all along they should have specified the risk-free asset as something more like treasury bonds. And again, what's really interesting about that gets back to kind of not a CAPM way of thinking about things, but an ICAPM way, where, investors actually have liabilities and they can hedge out those liabilities with, a risk-free asset that has a term structure of interest rates associated with it. We found all factor models were improved using treasury bonds as the risk-free asset instead of treasury bills. So that was kind of an interesting finding. So aligned with, taking factor investing and aligning it with portfolio theory, asset allocation. There seems to be an alignment between what we call asset pricing and portfolio theory. So Matt's questions, Jack, and your questions are actually well connected in that regard.
So, yeah, we're bringing it all together over here, Matt.
Success.
This gets a little bit outside of the paper, but I know you've worked in the industry for a long time and you've looked at active managers. And I'm just wondering, like, people who are listening to this have to evaluate active managers all the time. And they have to look at them and say, is there actually skill going on here? And I'm just wondering, what do you think, like, are at a high level, are things people should be looking for when they're judging an active manager or a fund to say, like, is there actually skill here?
Right. So, I mean, again, I think this is something unique that my team and I do at Northern Trust. In particular, I mentioned Charlie Grant. He's, one of our key gurus in asset allocation. But, in some of my papers, you've seen Steve Germani, who's our director of investment analytics, who does a lot of the heavy quant lifting for us. And then importantly, Dave Moore, who's our director of manager research, who's done a lot of kind of the evaluation on an ongoing basis of kind of the prevalence of manager skill in practice. So, we draft these papers, and stock market risk factors and manager performance evaluated all funds back to the 1970s, right? At Northern, on an ongoing basis, almost quarterly, we download the entire universe of not just fund returns, but SMA returns. And we, basically do ongoing manager screens and searches using these factor-based analytics on an ongoing basis. Now, some people say, oh, well, maybe U.S. large cap's not efficient. Let's look at small cap or emerging markets. I can tell you again, on an almost quarterly basis, we download the entire universe and constantly rerun these factor-based analytics. And over again, we find exactly the same outcome. It might be a little discouraging for people who are, interested in active management, but, the empirical evidence is very consistent and pretty strong. If you're talking about traditional fixed income investing, whether investment grade or high yield, if you're talking about equity investing, traditional equity investing, whether US small, international, the results are very consistent. And the reality is what it is. Markets are very, very competitive. There is almost no evidence, net of fee, that active investment managers have been able to generate, statistically significant, non-random, risk-adjusted alphas. And it almost doesn't matter what factor model you use. You sort of see that, whether you're just using a CAPM, an ICAPM, or 3-factor model, 4-factor model. And that's sort of the empirical reality. And we see it over and over and over again. Now, there's a distribution of alphas, but again, you have to be more sophisticated than just saying, oh, that manager generated an excess return. You have to ask yourself, is that alpha adjusted for appropriate risk? And then is it random or statistically significant? 80% of what we're looking at or more, roughly speaking, is random. A big trick in this industry is learning how to ignore the noise and pay attention to the information. Once you're able to do that, you really see that the distribution of alpha T statistics is very much random. And the prevalence of statistically significant alphas in the far right tails that we observe in practice is about the same or less than we would expect, than we simply expect by chance. So everyone eyes wide open. Markets are very effective pricing engines. There's no evidence, really, there's no compelling evidence that skilled investment managers, at least in public equity and public fixed income, are able to consistently generate alphas, particularly for forward-looking investors. Now, I'm going to say a couple other things. The degree to which you have an active risk budget, I'd suggest looking over to alternative investments like private investing in particular. There's far more evidence of alpha and that, of excess return, and ability of managers in private equity and buyout, et cetera, to kind of add value. And so, the degree to which you really have, an active risk budget, I'd suggest looking there and being far more efficient and, kind of creating, let's call them very efficiently implemented goal-aligned portfolios when you need to utilize, traditional fixed income and traditional equity. Now, the other thing I'll say there, and we wrote a sort of a follow-on piece where we actually looked at, the evidence for alpha in gross returns rather than net returns. And there is slightly more evidence, at least in active equity, for alpha before fees. It's a very small subset, let's call it sort of 4 or 5% of managers. The interesting thing, though, is that there's no evidence that historical gross alpha actually persists into the future. So, there are challenges even if you didn't have to pay fees. So, much smarter, I think, is to step back and recognize, respect markets. I mean, in a capitalist system, whether it's capital markets, goods markets, whatever, there's very little evidence that, quote unquote experts are able to sort of outperform markets and and identify either undervalued or overvalued securities. You're far more likely to get good outcomes if you're very thoughtful about fees and taxes and being very efficient in, again, aligning to a appropriate customized goal line portfolio. That's far more likely to give you a better outcome, which I think at the end of the day is what everyone cares about.
Yeah, and to your point, even sophisticated managers, have a hard time, identifying like skilled managers. So like your average individual investor, this is a very, very daunting task to try to identify active funds that are going to outperform and, it's very, very challenging.
Yeah, I mean, I don't think institutional investors really have an edge, to be honest with you, simply because the overall results say the same thing and everyone's faced with the same reality. If you have a good outcome hiring an active manager, it's because you were lucky, right? And if you had a bad outcome, it's because of fees and because you were unlucky. The bottom line is the evidence strongly suggests that net alpha is almost entirely random. The only benefit an institutional investor would have over a retail investor is that they will pay lower fees. So again, I get back to, that's sort of the reality everyone faces because markets are highly competitive, right? Turns out, everybody, capitalism actually works really well. The best evidence of it is in capital markets, but the truth actually goes to all sorts of markets. And I think respecting markets is the first lesson of being a good investor. I mean, actually, whether you believe in efficient market theory or not, even if it's not 100% true, and almost probably nobody believes it's 100% true, it's sort of like 95 to 99% true. And that creates sort of this really sound analytical framework to think about a lot of different things. And so at least if you can accept that, I think that's interesting. I think it was Fama who said, ironically, of all the theories in economics, efficient market theory probably has the most empirical evidence associated with it. Now, that says a lot about economics in general, but step back and think about that. Of all of the theories in economics, EMT probably has the most empirical evidence behind it. So it's a good analytical framework at a minimum, even if it's incomplete and not 100% true.
I just had one more before I hand it back to Matt. I wanted to ask you about inflation in the 60-40 portfolio, because last year we had our first year in a long time where stocks and bonds went down together. And, a lot of investors listening to this podcast have sort of used those as the core building blocks of their portfolio. They've got their stocks and they've got their bonds. And a lot of people are now arguing that in this inflationary world, maybe that's not enough anymore. Maybe people need other things in their portfolios besides stocks and bonds. And I'm just wondering how you think through the current inflation and sort of the future for the 60-40 in the world we're in now.
Yeah, I mean, so there's a lot I could kind of address on that. So first of all, when people say, oh, something different than stocks and bonds, there's either two flavors there, right? Like it's, are you talking about, things like REITs, and what are you talking about there, which are frankly stocks already and probably incorporated and included already in the total market of equities, right? So, or are you talking about things like commodity futures and things like that, right? Which aren't capital assets. And so therefore, really maybe don't have a positive expected return associated with them like capital assets do, because capital assets have a claim to future cash flows, which generate an expected return, right? They finance the economy and so therefore have a positive expected return. So I always say at Northern in particular, all our portfolios are comprised of capital assets. And that analytical framework, I think, enables you to avoid mistakes where you invest in things that, maybe don't have a positive expected return associated with them. So that said, stepping back and thinking about inflation, I think you ask another great question, because in both looking at the history of inflation and not just the 1970s, you could go back to the post-World War II inflation, which was horrible. And it took decades for bond returns to recover their inflation-adjusted value after World War II. People don't realize that. It was like 4 or 5 decades it took for bond returns to recover their value. We all know and are aware of what happened in the 70s, a significant inflation bout. And as we have built very sophisticated models to evaluate inflation risk, particularly over the last sort of 5 or 7 years, again, I think the big latent risk people don't appreciate enough is the risk of inflation. And so even if you are a highly taxed investor in the highest marginal rate, and you love to own municipal bonds for the tax-free interest income, I would encourage you really to think long and hard. If you have a real goal profile you're trying to fund, the role of taxable tips in those portfolios, because again, if we're trying to hedge out goals that are inflation sensitive, really, tips are, one of your best tools to be able to kind of deal with that inflation risk, which again, I think is far greater than even now most people appreciate, because it has the ability to really significantly undermine your goal hedging portfolio if it's not constructed in the right way, and your entire goal profile for that matter. The 60-40 portfolio, yeah, I mean, on that, again, I would step back and say, like, why 60-40? I think, let's understand your goal profile in far more detail, your risk preferences around that. And you should have a customized dynamic asset allocation that you can adapt to over the course of your life, not some 60-40 that, is one size fits everyone. But that said, clearly I think, markets are pricing in the new environment. Like I said, respect markets. I think it's the first rule of being a good investor, respecting markets and the information that market prices signal to you. And I don't think there's anything wrong with a 60-40 portfolio for, a go forward asset only investor who doesn't consider their goals. But I think you probably want to be very careful about how much inflation risk you want to deal with on the 40 part of that portfolio, because I do think it's today a latent risk that a lot of investors don't appreciate. The final thing I'll say on that, and John Cochran, I mean, he was a great living economist. I think one of the best living economists today. He originally pointed out, and this is true, he validated it in some tests in a piece we wrote called Market Conditions and Predictions, where we showed that if anything, markets seem to be, pricing inflation risk into bond yields looking backwards. At least historically, they've done that. Now, maybe with, the inception of tips and break-even inflation, markets may do a better job of pricing it going forward. But, if that's the case, it may or may not be the fact that current bond yields already are good at incorporating forward-looking inflation expectations. They may be sort of reverting back to a view that, hey, the last 10 or 20 years is what's going to happen again, despite what we just went through. I don't know the answer to that. I'm not here to forecast what inflation would be. To me, I look at tips break even as your best bet. I believe in markets as a first step, but I will say it's a risk, and it's a huge risk, and it's an underappreciated risk even today. From a portfolio construction perspective, on the risk, on the goal hedging side, you need tips or inflation swaps with municipal bonds to really mitigate that risk. And we found, and we built in the portfolios on sort of the risky asset side, natural resource equities or capital assets, you get expected return that have an inflation correlation historically, and our client portfolios have definitely benefited from that. Net inflation beta is larger than 1, so the protection is more than the allocation in the portfolio. But it's not a hedge, it's a mitigant. There's no guarantee it works going forward, unlike tips, which, have that inflation adjustment in them. The final thing I'll say on that, though, tips work best, not in an asset-only framework where the correlation's not as strong as you'd expect because of movement in the real yield, but they work best in a liability relative or goals-based framework where they're used in a duration-matched way to fund a discrete goal profile. When you cash flow match your tips maturities with your goal profile, you have a perfect inflation hedge. When you don't think about inflation from a goal hedging perspective, your correlation to inflation is not as strong. So again, a goals-based perspective helps you significantly mitigate inflation far more than an asset-only perspective does.
Which is super important for people in the real world, right?
Exactly. Right. Exactly right. So.
And I just want to hit this point without misusing the words. When we say dynamic in the approach, there's also, I think, part of what you're saying there too is like, because you can't predict inflation, you have to make some assumptions, but then you have to retest or recalibrate. Do you just want to make any comment on rebalancing, or as you think about how this evolves on a go-forward basis in the real world?
Yeah, because when I say dynamic asset allocation, you're right. I thank you for answering that. I don't mean that you're a tactical allocator constantly adjusting your portfolio based on your views of how assets are going to behave in the short term, right? What I'm saying is that we're creating a long-term. These are portfolios for long-term investors, right? And the safest place for you to be is in your goal line portfolio. that's optimally constructed to fund a lifetime of goals, which is going to go on for 30, 40, plus years in many cases. And what I mean by that is that, a dynamic goals-based asset allocation is going to be dynamic for a number of reasons. As you move through the course of your life, your goal profile is going to change. Some goals are going to pop off. New goals are going to enter your goal profile. The priorities you attach to each of these goals are going to change as you move over the course of your lifetime. With that, you get a dynamic or changing asset allocation over the course of your lifetime to align with your goal profile as it changes through the course of your lifetime. And so that's what I mean by a dynamic goals-based approach. It is a long-term, slow-moving change in asset allocation to align with the evolution of the profile of your goals. Now, you may also adapt along the way. Your risk preferences may change. Surpluses and shortfalls may evolve. As you get a surplus, you may have to have decisions around allocating that surplus to future goals, potentially increasing consumption, additional gifting down the road. Ultimately, we want to allocate all surpluses because if you don't, you essentially have an unplanned bequest at the end of your lifetime. At the end of the day, as far as I know, right, either you're going to plan for how you're going to consume these goals or it's just going to go away as an unplanned surplus or an unplanned bequest, which makes no sense. So at the end of the day, all surpluses will eventually become goals if they haven't already. And then shortfalls you're going to have to adapt to also, right? If there's a shortfall, then you're going to have to adapt and change the portfolio. So I'm not talking about sort of the asset only moves like, we like international now instead of US equity. Let's overweight there, underweight there. I'm talking about, these are portfolios for long-term investors and constructing them accordingly. And that's going to create, interestingly enough, a customized long-term dynamic asset allocation.
Which is such a huge point, because I think that's one thing maybe people don't understand about professionals in the space who aren't just making the tactical bet on developed markets over emerging markets or something, but saying, how does this current environment realign with the goal, this liability you're trying to meet in the future? Right. That's why you go get help, right?
And Matt, yeah, exactly. And then just on that point, just getting back to the efficacy of a lot of the tactical asset allocation, right? Like making those short-term bets. The interesting thing, and this gets back to the CAPM framework where, at least for the risky assets, you have this anchoring benchmark portfolio of like the market portfolio of all capital assets, which, is sort of, you can, again, is the connectivity between CAPM asset allocation and where you may kind of decide to intentionally overweight or underweight asset classes. And in that framework, we've shown in a paper called sort of, an efficient benchmark for asset allocation, we showed that like the 2/3 of discretionary asset allocation managers who basically can make these tactical calls to over or underweight, capital assets globally underperform just the market portfolio of all capital assets, which again goes back to, that's an efficient markets perspective. Again, it goes to show you that, much like, active management and fixed income or equity, these tactical short-term moves in active equity don't seem to outperform just a globally weighted market portfolio of all capital assets, the efficiency of that kind of a portfolio. So again, everybody, eyes wide open, right? The best thing you can do is create these goal line portfolios. And then the next important thing is to implement them extremely efficiently, tax efficiently at low cost and service of the goals. And the degree to which you have an active risk budget, you can improve those portfolios by spending it on alternative investments. I mentioned private equity. We didn't talk about hedge funds. Most hedge funds are not interesting, too expensive, tax inefficient, but there are select hedge fund strategies we've been able to identify that generate uncorrelated, highly diversifying returns that can improve upon portfolios when done right. That's pretty sophisticated, very difficult to do. You have to be highly selective, but to be fair to active management, there are areas that it sort of shows up, but you have to be very careful and highly selective. In the meantime, respect markets. There's a lot of good information in market prices that can inform an investor.
So take us to, we'll bring this home for you. Take us to active life management for a second. You made a comment years ago, and I can't remember if this is when I first came across your work or not, but you did this interview with Meb Faber, and you talked about how as we move forward in life, you found a lot of the stuff you enjoyed in middle school, you're enjoying again and appreciating. And so like active life management, you're going through these chapters, you're feeling the stuff in your own life. You don't have to answer this on some super personal level, but talk about how like purpose isn't just assets. It's how you live. It's like the other side of this human capital thing. How are you thinking about that these days?
Yeah, it's funny that that you remember that. And I mean, I don't, obviously, why would I have any more insight than any of you guys do or anyone else in your audience? But I can just speak for myself. And yeah, I think that maybe that insight about middle school, I do think it's affected me. And even since then, as an example, right, like with COVID out where I live, there was limited opportunity for recreation. And so I picked up cycling and mountain biking. Again, something I had, since that interview with Meb, and something I had done a lot in middle school, mountain biking where I grew up. There were the Santa Monica Mountains kind of behind the neighborhood I grew up in. I did a lot of mountain biking as a middle schooler. Again, picked that up again in addition to kind of tennis and fishing, which I think were the two things I mentioned to Meb. Started the mountain biking, and I still do this, every weekend to this day, right? And so it's another factoid and supportive, I guess, of that original thing. So for me, it's worked great, and I try to kind of get my kids to play sports that they can also do over the course of their entire life. So, I've gotten them to play a bunch of sports, but with a mind towards things they can do their whole life. I live in Southern California, fortunate enough to live near the beach. And so my girls are into beach volleyball, they're into surfing and those sorts of lifestyle things, in addition to the sports they play in high school. And the thought has always been, those two things in particular, if you're going to have a beach lifestyle, you can do it till you're 65, 70 years old. And, I try to get them into it kind of in their middle school or early high school years. And it seems to be sticking so far. So, I think that's, maybe I was right about that one.
Peter, this has been excellent. Thank you very much for spending so much time with us. We will put links to your papers that we discussed in the show notes, and the invitation will always be welcome. You'll always be welcome back on the podcast. So we hope to have you or maybe some of your colleagues on in the future. So thank you very much.
Yeah, thank you guys. I enjoyed this. I thought you guys had a lot of great questions. Kudos to you guys. I think you have a great show. So
This is Justin again. Thanks so much for tuning into this episode of Excess Returns. You can follow Jack on Twitter at @PracticalQuant and follow me on Twitter at @JJCarbonell. If you found this discussion interesting and valuable, please subscribe in either iTunes or on YouTube, or leave a review or a comment. We appreciate it.
Justin Carbonell and Jack Forehand are principals at Mladina Capital Management. The opinions expressed in this podcast do not necessarily reflect the opinions of Mladina Capital. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Mladina Capital.